Good evening, friends. So I would like to welcome you to the third day of this wonderful series of sessions on boardroom dynamics. As we understand, the Companies Act 2013 brought in an era of self-governance, and that was something which was very new to the Indian companies, which actually has brought in an extra burden on the directors, and in fact, it is rightly so on the independent directors. And so, in the today's session that we have, we are going to discuss whether directors are just rubber stamp or they really have to go beyond and they have to use their discretion. And we have excellent faculty with vast experience with us. CA Mukesh Butani, and he will be able to share with us, what is his guidance for independent directors. And we also have Uday Lajmi, who will join us later on for the panel discussion. Now, I request my council colleague, CA Manish Gadia, to please go ahead with the introduction of the faculty for the first session, CA Mukesh Butani. Manish bhai, over to you. Manish bhai, you are on mute.
Thank you, Doshi madam, for giving me this pleasant task of introducing Mukesh sir. But before that, I will tell you that the program, 3 days program, what you structured is really a fantastic program. And I think since when I've joined WIRC, this time, first time we are having this kind of program where we are discussing something, the course is for boardroom dynamic, that is for directors, and what is for the company's boardroom. So really a fantastic job, Doshi madam. Now coming to the task of introducing Mukesh Butani sir. Mukesh Butani sir is a chartered accountant and BCom he has done BCom. He has a law degree also and practices as an advocate before various tribunal, High Court and Supreme Court of India. He is a founder and managing partner of BMR Legal Advocates, a boutique firm specializing in the area of corporate, international tax, transfer pricing, GST, customs and trade, with expertise in litigation services, controversy management, strategic transaction advisory, and policy. With specialization in domestic, corporate, international tax, and transfer pricing, he has over 3 decades of experience in advising multinational and Indian companies on a wide range of matters relating to FDI policy, business reorganizations, cross-border tax structuring, tax controversy and regulatory policy. He is acknowledged expert in the area of international tax policy, controversy and advocacy, and has to his credit several landmark judicial pronouncements. He has, because of expert witness of contiguous cross-border tax treaty and transfer pricing matter in foreign jurisdiction. So with these few words, I present before you CA Advocate Mukesh Butani, and he is going to take us through beyond compliance, making board add value, and board beyond rubber stamp compliance and adding true value to the business. So very interesting topic. We are going to listen with next 80 minutes. Over to you, Mukesh sir.
Thank you very much, Manish, for the generous introduction, and thanks, Drishti, for inviting me. How much time do I have to speak? You're on mute.
Drishti, you are on mute.
Yes, I think you have time till 6:15, 6:30.
Okay. Okay, fine. I don't know if I have so much to speak, but let me just start with the theme. And I liked what you started off with, Drishti, that is the independent board member a rubber stamp. Clearly, the answer is no for that. Whether it's got to do with people like us who are professionals and who occupy this important fiduciary responsibility, or whether it's anyone else who's not professionally qualified, more so in the 2013 Companies Act. What I wanted to do was share some of my perspectives on why that is not the case. And I'd like to touch on some of the themes that I had in my mind to be able to support this point. And my themes will focus on number one, the related party transaction, because that is a very important part of the debate for boards. Second is the succession planning, which again is assuming a lot of importance in today's environment. And I think boards have a very important role to play. And I will share some of my experiences. Some of it is known in the public and some of it is not known in the public, and what my experiences have been. I also wanted to talk a bit about the risk management and how the risk management committee can play a very important role. Then I will touch a little bit on the wider corporate governance in the COVID area, because there is no topic of discussion or debate which is incomplete without talking about what role do boards have to play in this particular environment. And then also touch similarly on the business continuity plan and the post-COVID 2019. I will touch towards the end on audit independence and accountability and corporate social responsibility, but that is subject to time availability. Whilst I'm touching on these themes, I wanted to also give you a framework for how are the regulations evolving, whether that is by way of SEBI floating several kind of papers suggesting reforms, or whether it is other forms of reforms which are in the pipeline. I personally see many of these reforms becoming reality. Whether they are reforms or they are putting onerous responsibility on the board is something that we can debate further. And more importantly, the fact still remains that SEBI, in its role as the premier regulator, has been seeking a fair bit of stakeholder consultation in this area as well. So I'll talk about that as well. Well, let's first come to related party transactions. Two major events. I mean, one, the 2016 LODR regulations, the 2013 law, which came into effect in 2014, and how related party transactions under 177 and 188 came into the realm of a very, very important compliance requirement for the board, for the audit committee, for the KMP, for the CFO, and others. The evolution of that moving into the committee that was set up in 2016, and then the changes that were brought about as a result of that committee of 2016 in 2018, wherein the SEBI regulations provided for some bit of flexibility in relation to what is a transaction in the ordinary course of business and what is not in the ordinary course of business. The concept of omnibus approval was born. The threshold of 1 crore of transactions being covered under the omnibus approval was also covered. Now, all of these are in regulations, and I don't want to talk about it, except for making a couple of points, and again, based on my experience chairing the audit committee of some of the listed companies. Number one, what is the verdict insofar as the reporting of related party transactions under the New Companies Act is concerned, vis-a-vis responsibility of the independent board members? Clearly, it's a welcome move. It's been welcomed by board, and over a period of time, my experience and experience of other independent board members particularly, and other members of the audit committee who are not independent board members, has been that this sounds like an onerous responsibility, but in the interest of governance and transparency, it has worked out very well. My overall impression is that it embraces best practices suggested by the OECD, even by the United Nations, and it is working well so far. The relaxation that happened in the 2018 also was welcome, because many boards, including some of the boards who have got awards for best managed, best governed companies really found that one is to say that the you follow the statute, which is seeking a prior approval of the audit committee. Second is what has happened in reality, which is that the audit committee has approved it, but on a post facto basis. We all, as chartered accountants and lawyers, are intimately familiar with the principle of ratification of transactions. Some of the large companies I can think of did make a specific mention in their related party transaction policy, which, as you know, under the law has to be now uploaded on the company's website, and it's also available on the MCA website as well, clearly providing that the mandate of the audit committee and the board in specified situations where it has to be taken to the board clearly means that some of the transactions would be of a nature where the transaction would occur with the related party, but the approvals for those transactions will be on a go forward basis where the board or the audit committee will ratify these transactions. So that is the situation so far. Now let's look at the SEBI reforms or suggested reforms. In January 2020, SEBI floated a paper wherein it suggested certain forms of reforms, which in my view are tightening up some of the provisions under 177 and 188 of the Companies Act. The stakeholder consultation could not happen with the degree of intensity that SEBI expected, but I know for a fact that I did participate in this. And three, four important aspects that are worth mentioning, excuse me, were as follows. Number one, a concept of a deeming provision that has been introduced or suggested rather by SEBI in its January 2020 paper on related party transaction. And this is a very interesting concept. And as you will see, that many of these changes that are being suggested by SEBI are seem to be a more reactive, seem to be more a a suggestion that is going to deal with a problem that has already happened, but it could prove onerous to the board requirement. Let's say, for instance, the deeming provision. The deeming provision says that all the persons and entities which are belonging to the promoter or the promoter groups, irrespective of their shareholding in the listed entity, and persons with direct or indirect shareholding of 20% or more would be covered in the definition of the term related parties. Now, in my view, leave alone the legalities of this deeming fiction, these forms of situations could cause one, interpretative challenges, and put, in my view, disproportionate amount of responsibility on the audit committee. How are you supposed to figure out what is direct and indirect shareholding of 20%, particularly when you are trying to bring together under the umbrella of related party transactions between promoter and promoter group companies, and that too irrespective of their shareholding in the listed company? It would become a very, very difficult exercise. I have no doubt in my mind that in future, when shareholding and cross shareholding tracking mechanisms are developed, it would be easier. But this is something that I personally critiqued, that it is difficult to achieve. The second aspect, which is interesting aspect, is that under the current dispensation of related party transaction, there is a difference on transactions to be approved by the audit committee, which is called in the ordinary course of business, and what is not in the ordinary course of business has to go to the shareholders as well. The new requirement has come out with a with a proposition which says prior approval of the shareholders are required if the transactions are material. So from what is transaction in the ordinary course of business, you go to materiality. So the materiality, which, and there are no exceptions given in the related party transactions as to what is the ordinary course of law, so on and so forth. So as it stands today, audit committees take a view as to what is in the ordinary course of business, and you need to draw a context to the business of the organization to come to that determination. Now, in the new SEBI proposal saying that shareholder approval, and that to a prior shareholder approval for carrying out material related party transaction, in my view, is not reformative at all, and it's likely to put some pressure. The third important criteria is lowering the threshold for value of related party transactions. So the current threshold is 10% of the consolidated annual turnover. Now it is suggested that it should be 5% of the total revenues or net worth of a listed company on a consolidated basis. So from the current 10% share, threshold, 10% of the turnover or 1,000 crore, whichever is lower, you're moving on to 5% of the total revenues and or the net worth of the listed company. Now, I can see some sense into this. I can see the underlying rationale. I can see the undercurrents why these are coming through, but this is what I call it as a tightening approach, and I won't comment on the correctness or otherwise of that. Fourth, regulation of listed companies at the subsidiary level. Now, this is very tricky, and maybe this is very, very specifically targeting the situation that the regulators encountered with respect to ILFS kind of situations, or possibly DHFL kind of situation. It says that prior audit committee approval is required not just for transactions of listed companies with the unlisted company, but even if a listed company or its subsidiary has a transaction with a related party of a subsidiary or any of its subsidiary, that is also covered. So here you are now talking about a situation where there is an audit committee of a listed company. The audit company of the listed company has a unlisted company, and under the current law, SEBI LODR regulation, the listed company audit committee has to look at transactions with unlisted company, related party transaction. Now, this unlisted subsidiary has a transaction with another unlisted subsidiary. Whether it is related to that subsidiary or whether it's related to the parent, that gets covered. Now, this I can see a sense for it from a regulatory point of view, but I just wanted to point out that this is another important requirement. The fifth requirement is a very interesting requirement, which I felt that under the current environment, the boards of many companies follow. And this requirement is, what is the minimum information that should be provided to the audit committee for approval of a related party transaction, which is what the SEBI paper says, information mandatorily required to be provided. And it talks about what's the type of transaction, what are the material terms, what is the name of the related party, what is the tenure and value of the transaction, how does it translate in percentage of listed assets, annual total revenues, total assets, net worth, what is the justification, and copy of valuation or external party report if any such report has been relied upon. You know, as a transfer pricing expert, I always felt that this is like a cup method, comparable uncontrolled price. So if a listed entity has to have a related party transaction, it has to demonstrate that, you know, I actually sought a quote from an unrelated party, but this quote is better and hence I'm giving it to a related party. Now, in my view, this is a fairly defensive way of supporting the arm's length nature of a related party transaction. And I think that this would put, certainly, my experience on board of some multinationals has been that this is going to be critical, because in a multinational environment, related party transactions are common, are frequent, and more importantly, those are the ones that are listed now in India will face this onerous requirement. So really, this is what I wanted to talk about in the context of the SEBI new future of the regulations on related party transaction. In fact, when Drushti called me up and I said, you know, it is such a broad topic, what do you want me to cover on? And I said, okay, let me pick up 2-3 themes. And within those 2-3 themes, rather than talking about what is the law saying now and how is the law looking at it from a board standpoint, let's talk about what the boards have to look at it in the future. So I just wanted to keep in my talk in line with that understanding that I had with Doshi. I also want to talk a little bit about the SEBI paper on corporate governance that has been floated actually in September 2020, and few of the chambers of commerce, where I am on the corporate law committee, did seek my view. Now, there are some very interesting changes that are coming up. If you look at the SEBI corporate governance paper of 2020, and again, I think some of these requirements are, I can understand the intent, but I actually question the wisdom and the practicality of this making it work. So one recommendation is that the stock exchanges should immediately be notified of the financial results of the board meeting. And what is immediate? Within 30 minutes of being given an approval. Now, I don't know how this is going to follow. So let's take a practical scenario. There's an audit committee meeting followed by a board meeting. It is the audit committee meeting that discusses the quarterly results, and then it places the financial accounts that it has discussed in the audit committee into the board meeting. So I know that the SEBI paper makes reference to financial results of the board meetings and not of the audit committee meeting. But how is it practically possible? What if the accounts have to be discussed and that's the first item on the agenda? So I just find this a little bit strange, if I may say so, and impractical. I could have understood that if it had said that suitable press announcements should be made, say by midnight of that particular day when the board declared the results. Normally, as a good practice, my experience has been that when quarterly accounts are approved, there is a draft board release that is done where the chairman is quoted or the chairman goes on the television or talks about the financial results. But to say that it should be notified within 30 minutes of the approval, it sounds a little bit kind of a little impractical to me. Now, so I explained one practical situation. What if the financial results arise from the first item on the agenda? It may be too late even to wait for the meeting to conclude before even informing the stock exchange. So these are some of the aspects that can give rise to challenges. The other is that the publicly available policy on dealing with board members which have conflict of interest, including those of related party transaction. I think in my view, this is a very reformative thing, and I have no doubt in my mind that this will help improve the governance. Some of the other suggestions include formal valuation of a related party transaction by third parties and actually retaining independent advisors to oversee if there are conflicts of experience. As a matter of fact, currently there are many boards who do follow the third party independent advisors valuation. There are independent experts who may also be consulted by the board to analyze material related party transaction. Actually, these are being followed. I see many of these things getting formalized as we move into the future. The board should set out a clear direction and culture on all related party transactions, in my view. Now, some of the best corporate governance practices also say that why is the entire attention on the audit committee? What is it that the management can do? What is it that the board can do? I see on related party transaction as an independent board member a disproportionate amount of burden on the audit committee. And to some extent, based on the experiences that I have had with some of my, not my experiences, but some of my colleagues had in other boards, is that when it comes to related party transactions, the board says, well, this is the mandate of the audit committee. I think that's incorrect in my view. The board should set out a clear direction and culture. I think they have a very important role to play. They should set out this direction with regard to all related party transactions, with regard to mandatory reviews of all related party transactions. Set out a low threshold. Say anything which is above 1% of the revenue of the company, we're going to do that. Let the regulator, let the reader of the financial statements actually read the related party transaction. Let the analyst, let the shareholder be given that comfort that this is a board that believes not just in strict compliance with regard to the wording of the law, but also the spirit of the law. Let the board lay down who are the vendors and service providers that are supposed to be declaring their conflicts, if any, before they are empaneled with the company. So as we are speaking, many boards follow it, but these are some of the aspects that I wanted to know. I actually came across a very interesting internal control system with regard to IFRS reporting, as which is a benchmark by the United Nations CTAD, which talked about the fact that now since the financial reporting under Ind AS complement with the IFRS requirement, which further complement with the secretarial audit requirement under section 304, and now we have the CARO 2020 with regard to related party transaction, leave alone not to forget section 149 on the internal audit, which is expected to present a true and fair view of the state of the company affairs. What is it more that we need? Essentially, what we need to do, we need to bring together all of these, because we don't need a over regulation over here. So when I look at some of the SEBI consultation paper on related party transaction, best governance practices on related party transaction, I think we have a lot on our plate. We need to sharpen this, we need to improve this over a period of time, and we don't need any further legislation. Let me move on to the second theme on succession planning. I came across a very interesting paper done by my friend Arun Dugal. He was a former CEO of Bank of America, and there are some very nice inputs that I could pick up from the IIAS, working papers on boardroom succession and the role that the boards have to play. I think let's try and identify the current problem, and some of them may be very semantic. How our Indian style of doing business is. Now, we cannot run away from the Indian style of doing business, but let's try and recognize the planning. Number one, inherently as Indians, we are not very good in planning. We manage everything at the last moment. And sometimes some people in my part of the country call it as a jugaad, right? So let's recognize we are not good in planning, and hence we are not good in planning. Otherwise, when it comes to succession issue, it becomes more like an accident. Okay. Now, what is the SEBI requirement? So I put the SEBI requirement really in two categories with regard to succession. One, board's ability to identify skills and expertise amongst members, and two, boards to look at the diversity policy when it comes to women director, which is kind of now becoming a tick the box rule. But anyway, that is the requirement. Now, we still have a challenge on dealing with family controlled businesses where whether it is written in the family document or otherwise, that it is the chair and the managing director who would be coming from the family, the host of the conflict or other forms of mandates that are there. So that's the reality. So we have our Indian practice, not very good in planning. We have our SEBI law, which has stated what it wants, and then we have the real challenge at the ground level. Now, what are the recommended practices? Now, here are some of the some of the recommendations that are coming in, whether they are coming in by way of global best practices, because this situation is not unique to India. There are many countries which have the DNA that you have in India, the family control business. You look at Italy, you look at many parts of Asia, these challenges are common. And hence, how do you deal with it? Clearly, the focus is on the Nomination and Remuneration Committee, or REM committee as is popularly called. Some of the committees now are looking at the 5-year board succession planning. And this 5-year board succession planning is not just for the CEO and the chair or the non-exec, but even for the non-executive directors. Some of the best practices suggest that ensuring that there is a reasonable overlap between the incoming and the outgoing non-executive directors. You really do not want 5 non-executive directors, all their terms getting over in a span of 1 year, and a new set of 5 uh, non-executive directors come in. So the reasonable overlap in the planning is very, very important. It may also not be possible in the Indian environment to have an assortment of skills on the board. Therefore, in my view, the Nomination and Remuneration Committee should plan for subcommittees or an advisory board of experts. That is what is also being recommended. I also feel that the Nomination and Remuneration Committee should actually try and look at a complete inventory of skills and expertise that is there within the board members and the committees, and look at filling those gaps on a real life basis. Some of the new mantras of skills and expertise go much beyond the traditional model that we use, which is by like saying we need one lawyer, we need one chartered accountant, we need one good HR, we need one good marketing advisory. So those are all there, but now we are going beyond that. Boards are looking at skills, which includes, digital, social media, capital markets skills, private equity, someone who's a risk management guru, so on and so forth. So these are some of the changes that are coming up and filling in on the desk of the Nomination and Remuneration Committee when it comes to succession issues. I also feel that the NRC have a very important role to ascertain where is the strategic thinking coming from, and more importantly, the in-depth ethical values that surround a board. Because boards are no longer tick the box; they are no longer this one-day exercise. I think it's more of a continuous yearly involvement. Even between 2 quarters, there is an engagement that the management has with the board, and hence that strategic thinking is very important. Does the CEO, does the managing director, or does the CFO feel comfortable in the middle of 2 board meetings to pick up the phone and talk to the non-executive director? If the composition of the board is correct, I have no doubt in my mind that they would contribute towards the larger corporate governance agenda. Now, the NRC committees have also started looking at the terms, the limits, the age limits, and looking at shorter terms, 3 to 4 years, to facilitate overlap and transition. So 3 to 4 year one term and then extended. Concepts of automatic extension have gone away. The statutory limit of 5 plus 5 is going away. So these are some of the changes that are there. Of course, not to forget the gender balance at the board level. Why one woman director under the SEBI law? And I actually am on a board of a company which has 3 independent directors, and I have 2 women directors with me. So so you don't have to stick to what the mandate of the law is, but to look at what is it that you can do reformative. Maybe there is a particular class of business that requires more women directors. I do recall talking to a friend last week. She is at a very senior level in Johnson & Johnson at the headquarters in New Jersey, and they're looking out for someone, and she said, well, this position has to be filled only by a woman. And she told me that Johnson & Johnson has a 50-50 diversity of employees, and they carry it at the senior level, including at the board level. So here is an organization, perhaps the very nature of Johnson & Johnson business mandates them to do that. So I actually sit and wonder, why do we have to look at just the compliance with the law, one woman director? Why can't you have 2? So I think the gender diversity plays an important role, and I think you need to look at this as well. just few aspects that I have seen the NRC committee playing an important role, which is a plan for the chief executive officers, plan for the board chairs, and plan for the committee chairs. And again, each of the plans for CEOs, board chair, and the committee members could differ. Now, again, in the Indian context, there are some very interesting analysis that are coming out. One is corporate governance in the family-owned business is very, very different. But if I look at some of the examples and notable example, few notable examples that I wanted to talk about, not to the exclusion of others, is how Marico has kind of structured itself. It's a family-controlled business. How they have implemented the succession planning, including inviting potential few CEOs to the board meetings. You look at Mahindra's is another example. There I completely understand the Indian promoters' psychology not to let go easily, and hence the substantial planning does become a challenge in many of these organizations. But I can tell you that some of these examples that I'm talking about in the context of Marico or Mahindra's or others which are family-run businesses are good examples to emulate. Some other families have retained the the control within the family, but they still have a very well documented policy. Some of the notable examples would be Dr. Reddy's, Bajaj, Imami, Murugappa Group. They all have adopted what is called family constitutions to preserve the interests of the family and the business separately. So there is a family member, but these are some of the good boards. As I had mentioned, these are just some of the examples that are coming to my mind. I'm sure there are many others, but there is a significant lot that has to change from the point of view of changing the culture of succession in an Indian organization. Succession planning is a challenge, the host of the board dynamics, how to go and grow and create lasting family businesses is a very, very important consideration. I'm reminded of this report that was done by EY on what are the aspects that need to look into it. And it just did not address the board dynamics, but it also addressed the non-board dynamics. This report examines, the family and the businesses could be contradictory in terms of approach, in terms of behavior. The succession planning could lead to potential frictions in the family and conflicts and litigation, which could harm the shareholders and the general public. And it's kind of suggesting some very nice tools for planning succession in general, which includes the dynamics of the board. How do you look at fiduciary structures, the trust structures, where the succeeding generations of the family benefit of the wealth that is being created? How do you look at wills? How do you look at family constitutions, charters? How do you codify both businesses and family aspects, enlisting the background of the family, their ethos, their economic interests, conflict situation, who will resolve those conflicts? These are some of the very, very good practices that are coming up. Succession planning versus legacy is an important issue that we have seen that play out in the board dynamics. We have seen this, what's happening currently in the context of Tata's. We saw what happened with Infosys. We are looking at this in the context of Raymond. These are the three notable examples that come to my mind with respect to Tata's. Conflicts did arise, and we know where it landed. We know it got ugly. We know that it got disrepute. It brought disrepute not to just the two most outstanding individuals, most respected individuals, but also caused a harm to the overall organization. But then the House of Tatas proved that it has such deep heritage of good leaders that the next person who stepped in revived it back. But the linen is still in the public and is dirty linen over there. We don't know where it will end. Similarly, in the context of Infosys, the founder's refusal to let go of the control, even with the appointment of a professional CEO, what is labeled as the rear seat driving, led to the exit of the CEO and 3 board members. But again, managed very well. Managed by who? Somebody who was one of the founder members, came back, and now it is back on track. Raymond's is another example of complete lack of uh, estate and succession planning, despite the family having faced issues in the past. And again, it is going the legal route. So these are some of the challenges that I wanted to talk about in the context of succession of businesses. Let's talk a little bit about the some of the other aspects. I wanted to talk about the revamp of the risk management committee. And again, I chose these 3 topics because there is SEBI consultation paper with respect to related party transactions and risk management committee as well. So this is very interesting. The consultation paper talks about proposed changes, and in fact, this is just a month-old development. It talks about the risk management committee having at least one independent director, as well as an internal auditor of the company. Now, this having at least one independent director is good because currently the law does not mandate it. I think this will do well. The risk management committee does require an independent committee. I don't see any reason how the internal auditor cannot play a very important role. So whether it's the in-house internal chief internal auditor or large companies that have outsourced their internal audit function should, in my view, play a very important role, or it should be a permanent invitee to the risk committee. The second important recommendation is to promote risk intelligence and transparency at all levels so that the day-to-day decision makers are aware of the consequences of that decision. So many organizations, as a part of the risk management function, do a good job in terms of writing down the policies, but it is only the day-to-day functioning of the organization that kind of gives you a sense whether the risk management controls are there or not there. And the ironical part of risk management efficacy is that until the time hell breaks loose, you never can make an assessment, or you can never test the efficacy of how strong the risk control is. When things go wrong, the first blame comes on the risk management committee, that the risk management committee didn't do this, risk management committee didn't do that. But nobody wants to now look at that, what is the functioning of the risk management. In many situations, I have found that the risk management committees are really playing a subordinate role to the audit committee. Why? The risk management committee, in my view, is as important as the audit committee. The risk management committee plays a far more proactive role. It is actually, in my view, the conscience of the organization. It is supposed to be, besides laying down processes, it is supposed to be acting as a periodic check on the health of the organization as to how it is. And the word risk is so wide in today's environment. You know, it could be economic, it could be political, it could be environment, it could be reputational risk, so on and so forth. So why is it that the risk management committee is not as important? I was actually, there are some very good recommendations in the SEBI paper on the role, or the new role, as they envisage of the risk management committee. And I just thought I will touch base on some of these issues. So the board promoting a risk intelligence and transparency at all levels, those sounds like a motherhood statement, but it's an important statement. Then comes the need for identification of risks, that the committee is being proposed should undertake classification of risks into various groups with corresponding management commitments and prioritization of each category of risk. So you're talking about every organization which has a risk management committee to look into identifying the risks, because the risk could be very different for different organizations. And then the committee will undertake the classification of risk, maybe an ABC classification, with now the management commitments to be able to address it. So this becomes a throughout the year dynamic process to empower the risk management committee. I personally feel that the role of the audit committee is rendered weak if there is no adequate risk management and risk controls that are there. And the current composition, the statutory composition of the risk management committee does require a revamp, and hence this latest SEBI paper is worth a look at it. The paper talks about some very interesting recommendations on a strategic report that should be made available each year, and it should be prepared by the risk management committee. And this report will include a fair review of what are the company's businesses, description on what are the principal risks and strategic goals, how the review of the risk management policies are taking place and how they are aligned to the organization's ethos. What are the uncertainties faced by the business? And in this environment today, this becomes very, very important. And more importantly, an assessment of future risk has to be identified. It goes ahead and makes some other recommendations that the minutes of each committee of each meeting of the committee, as well as the annual strategic meeting, should be placed before the board. Now that is obvious, but now this puts a greater degree of responsibility on the board, because if the risk management committee is going to put this strategic report, identification of risk, stratification of risk, which are the management people that are addressing the risk, now that comes to the board level from a seriousness point of view. And finally, it makes a recommendation that the annual report should contain details of the risk management committee's composition, the members, the meetings that they attended, and what were the terms of reference and change in policy, and more importantly, a summary of the strategic report as well. So now you are taking the risk management function through the details of what is expected of them, elevating it to the board level, and now taking it to the shareholders as well. So I think there are some excellent recommendations that are coming in over here. Let me come to my last three themes that I wanted to cover. One is corporate governance in the COVID era. There is no SEBI paper on this. I'm just going to talk about some of my experiences. I'm going to also talk about the business plan and post-COVID, because this is an important consideration from a more dynamic standpoint as we speak and where we stand today. And then I'm going to touch a little bit about the corporate social responsibility and the audit independence and accountability. Let me come to the corporate governance in COVID era. A lot has been written in the western part of the world more than in India, but some of my readings on the corporate governance in the COVID era suggest some buzzwords. Rewriting the rules of corporate governance. That's coming out very, very clear. And it came out very clearly in this paper written by Lynn Payne at the Harvard Business Review. For those of you who are interested, the October 6, 2020 Harvard Business Review has this outstanding paper, and I found it very, very interesting and relevant for us. So what is the theme of this paper? It essentially says that the pandemic has put questions on agency theory. And what is an agency theory? It's more of like a shareholder-centric model. And it says that instead, directors now have to consider the interest of all stakeholders, including employees and the general public. Well, even we don't need these fancy words like agency theory or shareholder-centric model to be able to explain, but the focus is how the directors should be concerned about all stakeholders, including employees and general public. And this is more so important in the context of Western countries, which could see a lot of layoffs that could happen. And that's why the focus is on employees, the health and the mental situation of the employees. It also lays down a focus on the company's cash position and the shareholder expectations, and hence it puts requirements on the board to consider the impact on employees and the government, the public, and differing groups of shareholders. And remember one thing, each shareholder group are likely to have different requirements, and it could cause friction as well. But it says that let's bring the focus on the company's cash and the shareholder expectation, and then consider the perspectives of other stakeholders. While concerns of equity have historically been disregarded as social issues, they now assume center stage insofar as legitimate expectations of the stakeholders are concerned. So in the Western part of the world, if there is a civil society movement, or if there are a group of activists, the boards kind of take a view. Well, these are social issues, we will handle it. But now this paper is pointing out that this will become a very important issue. I mean, just imagine the television, what we see in terms of the uproar that's happening in many parts of the United States. Leave the election issues on the side, but even in this environment, and the kind of risk that it is causing to various citizens, these are very, very big social issues, and large boards ought to be concerned with that. The fourth issue that has been pointed out in this paper is the executive pay and dividends to shareholders, and the approach of the board, whether it's a board or the remuneration committee, on executive pay and on dividends to shareholders will have to have a new definition, especially when you see large scale layoffs that are happening at the employee level. This has been identified as an important issue. And then it talks about increased responsibility for directors, whether it's got to do with they working closely with the management on strategy, or they tracking a richer or more advanced set of performance measures, overseeing expanded menus of risks, including those arising out of force majeure contracts, rethinking the compensation philosophies, engaging in thoughtful deliberation, reviewing board composition to ensure diversity and representation. These are a bundle of issues that are coming up. Now, we need to take all of these. How are we going to rewrite the rules of corporate governance? It's one thing to say that it is not business as usual, but how are they going to play out insofar as the dynamics of the group are concerned is something that is worth debating. So that's on rewriting the COVID rule. I just wanted to touch on a related topic on the business continuity plan and post-COVID, because that is more closer to the debate that I have come across. Now, a business continuity plan, what is it? It's simply stated, it's a document that traces the procedures and protocols to ensure that businesses are continued during and in the post-crisis situation. We know the kind of disruptions the pandemic has caused, and I have seen an increasing dependence and formulation of the business continuity plan that many good boards are following now, whether that's got to do with how companies are going to digitally transform themselves, how workplaces are going to be looking differently, what is going to be the marketing strategy in the digital era, identifying key products and operations which will keep the business going. Certain products are not doing well, certain products are going up high. Impact evaluation of each of these will have to be done really on a quarter-to-quarter basis, because as the economies get back, the quarter-to-quarter situation on each of these aspects are going to look very different as things open up. I don't know how many of you have read about the Debenhams, which had the famous UK store, which is very visible for people who go to London in the high street marketing area of Bond Street. Debenhams went through two restructuring for revival, and the last nail in the coffin was pandemic. And This is a nice case study that my son, who's going for his masters, is very passionately talks about, and I keep on informing him what's happening with debonance from the news that I pick up from media. But it's a very interesting case study that this is a classic case of a business that had to be revived from the insolvency proceedings twice, but the final nail in the coffin was this thing. That situation, mind you, is comparable to India, because we have a very active insolvency and bankruptcy code which has completely redefined how you run businesses. Those businesses are not just the one that have gone into the IBC process, but were likely to go into the IBC process just before we entered the pandemic. So what has happened to those businesses? It's one thing to say that there is a pause on the IBC law, but that pause cannot be forever. That pause is going to go away. And once that pause goes away, what happens to those businesses? Are we looking at a Debenhams kind of situation? So for the board, the business continuity plan during and post COVID, in my view, is a very important consideration. I will just touch on two aspects very briefly, in order to complete the wide topic that has been given to me. One is on corporate social responsibility and second is on audit independence. Very briefly, I think corporate social responsibility in the new era is going to be looking very differently. Now, why do I say that? I say that because, not because we need more corporate social responsibility in the COVID area, but this is evolving, and because India happened to be the first country that legislatively mandated this, I think this is going to assume more importance as we recover from the pandemic. Uh, I just came across some of the important developments on corporate social responsibility, and I came across how digital is playing a very important role in corporate social responsibility, and how some of the world's leading brands are making use of corporate social responsibility through digital and creating a brand for themselves. And mind you, this is very important for India, given the larger public policy stance that the Prime Minister has taken on digitization or digital transformation. So some of the examples that really appealed to me was, what constitutes a more social responsible behavior of the company towards CSR, and that the company is seen as looking beyond itself, looking beyond its employees. And who are the other two stakeholders? The community and the consumers. So, these are very important aspects. Some of these concepts are being talked about, but I can see that becoming reality in India. And as I see some of the boards touching on them, but now I see implementation occurring. Some of the important themes that are appearing to me on the CSR front in India would be reduction in carbon footprints, given India's commitment to the environment, improving labor policy, not necessarily through regulations, but through self-regulation, participation in fair trade on pricing, charitable giving, volunteering in the community, corporate policies that benefit the environment, socially and environmental conscious investments, not necessarily driven by regulations like no plastics, but actually seen as getting translated. Some of the leading examples on corporate social responsibility that I see many multinationals doing it, not just globally, but even in India. And I spoke to some of them, and interestingly, many of them are not even listed in India. For example, if you look at Johnson and Johnson's big push on corporate social responsibility by saying that we will pursue renewable energy options with a goal that 35% of the energy needs of our organization will be on renewable resources. Now, that's a very powerful statement to make, and that attracts the attention of large organizations. Interestingly, it's listed in India. Look at Coca-Cola. I mean, Coca-Cola's biggest business is the delivery of the Coke, for which they use trucks, and and there is a measurement that they have as to how many million metric tons of greenhouse gases does it contribute. So Coke has pursued a philosophy that by 2020 they're going to reduce the 3.7 million metric tons of greenhouse gases that they were emitting, 25%. So that's another one. Look at automobile companies like Ford and Nissan and Renault, and everyone is on this bandwagon of hybrid. But Ford emerges as amongst the largest automobile company by saying, okay, everybody is going on this EcoBoost engine drive. But what we're going to do is that by 2022, 40% of vehicles produced by Ford will be electrified vehicles, and electrified category includes both hybrid and electric as well. So that's another example. Look at Pfizer. That's very interesting because Pfizer has been in the news for other initiatives on the vaccine front as well. It wants to drive global initiatives that would raise awareness for non-infectious diseases. By the way, this is Pfizer's stated policy before we actually went into pandemic, and they already started talking about non-infectious diseases, which will provide healthcare for women and children. And one initiative that they took was reducing the price of certain forms of vaccines that treat pneumonia and blood infections. So I think there are many examples. GE talking about launching Eco Imagination, which is their renewable business strategy with a mission to bring down the not conventional forms of energy and generate clean technology, and actually has laid down a financial target that of $20 billion to achieve from green products. So there are many interesting examples that are coming up on corporate social responsibility. I see that this will become more pronounced in India, not just because of regulations, but because at heart we Indians are very compassionate people, and I have no doubt in my mind that corporate India will play a very important role on this initiative as a part of corporate social responsibility. My last point is on audit independence and accountability. The audit independence and accountability has been a debated issue. It got debated when I was part of a global Big Four, Arthur Andersen, and it collapsed after Enron. And immediately at that point in time, the ICAI came out with its own requirements, and then followed Clause 49 and SEBI. Everything came in. But I think that that debate is still on. And that debate is on for a host of reasons. Most people felt that the MCA consultation paper on audit independence and accountability, which they released in February 2020, was radical. Of course, it was radical. Of course, it looked at overhauling the existing system for audit of public companies. I won't talk much about that because it's got a lot to do with contentious issues, and I use the word contentious issues because in the accounting fraternity I have friends in the Big Four, I have friends outside the Big Four. I was a part of an entrepreneurial venture, but some of the radical changes worth talking about and which will be debated, and I think it will have a very important role in board dynamics, include the reduction of economic concentration of audits performed by large firms, uh, situations of conflicts of interest arising out of performance of non-audit services, the Section 144 requirement. I have personally felt that that is the most major area of conflict, Section 144. The current requirement of the Companies Act are just not sufficient to be able to address that. I don't know whether we can have a situation of complete ban on auditors performing non-audit services. That's a view that has been taken by many countries, but I do see several areas of conflicts that are coming up, including on some of the situations that the regulators are presently dealing with. Healthy competition between audit firms mandating joint audits. I think somebody's mic is on. There's a lot of noise. Hello? Yeah, I think somebody's mic is on. Yeah, thank you. So there are many situations on arising out of audit independence requirement, mandating joint audits of large companies. How do local accounting firms have a role to play in it? Mandating reviews of audits of subsidiaries is something very comprehensively covered in the MCA consultation paper to prevent the situation that we are seeing with the current crisis with some of the NBFCs, the concept of group auditor for the holding company, and more importantly, now the auditors increase responsibility to record the probability of default in loans by our companies in terms of benchmarking given by credit rating agencies. We've also seen credit rating agencies are important. Now, why are these important from a board perspective? Because simply that these regulations may impact the audit fraternity. These regulations may impact other stakeholders such as valuers, valuation experts, non-banking financial companies, investment bankers, or credit rating agencies. But the board ought to be educated about it, and hence it will play out in board dynamics as well, in my view, in a large manner. So let me pause over here and take questions if any. I really wanted to cover this more because these were some of my thoughts and reflections on how I see these becoming very critical from a board perspective. Thank you, Drishti. Over to you.
Mishra ji, question?
हाँ sir, दे रहा sir.
So we will take up some question. Butani sir, participants has posted. So request you to take up. Mishra ji will show you on the screen the questions.
Sir, दिया.
Okay, so I can see some question. This is like a classroom question. Let me see if I can audit it, answer it. A listed company has two wholly owned subsidiaries, wholly owned subsidiary manufacturing bulk trucks and selling it to the second wholly owned subsidiary. The transaction happens across the year. First wholly owned subsidiary makes losses from manufacturing product, whereas the second profits from the export of the same product. Can the audit committee of the listed company demand price revision between the two so that both make profit instead of the latter? Frankly, it could be too judgmental on my part to answer this question, but suffice to say that the audit committee, as a part of good governance practice, is well within its realm to ask the question that has been posted. Question number 2, is there any breach of SEBI LODR related party norms in above situations if the audit committee of the listed company continues honoring transfer pricing between the two wholly owned subsidiary as above? Well, I think that you have to draw context to this. Before I give you a yes or a no, this is not a legal question whether there is a breach of SEBI LODR or not. SEBI LODR today says transactions which are in the ordinary course of business has to be approved by the audit committee. the related party transactions has to be approved by the board. So here is a case which seems like a transaction which is in the ordinary course of business because it is in the same business. I'm presuming that the company has a strong related party transaction policy. If the board continues to honor it, the board has to make sure that it grants an approval to these transactions. And this is not a one-time approval. So you could have a situation where there is an omnibus approval given because the transaction does not breach the threshold of 1 crore of rupees. But what I have seen as a good governance practice in these situations is that no matter what is the repetitive nature of the transaction, these transactions should be put forth before the board for an approval. And it should be a prior approval, which means that on a quarter to quarter basis, you keep on taking approval for the other thing. Now, the tricky part in this is that the pricing of a bulk drug is very important. So are the terms of the contract getting varied depending on the pricing of the drug is an important consideration that should play in the minds of the board. Because if these bulk drugs pricing, okay, keep on changing, then so should the pricing for related party transaction also change. So that is another check I would apply to evaluate this transaction. So that's what on the second question. Third question is ISA 600 global standard require the group auditor to take ownership of consolidated financial statement. The Indian standard still allows reliance on subsidiary auditors and make reference to them and scope out responsibility. Do you think Indian standards should move in the direction of the international standard? Well, first of all, I must add a disclaimer that though I have practiced as a chartered accountant, I have never audited in my life and I have never signed an audited accounts. So I want to make sure that I don't give a wrong answer to this. Well, I'm glad that you asked this question because this question is exactly what I mentioned a while ago, which is the new MCA paper that has been circulated. The new MCA paper deals precisely with this situation. So the February 6, 2020 MCA paper, which is called a radical overhaul in the existing regulatory framework, specifically talks about a requirement mandating review of audits of subsidiaries by what is called a principal or a group auditor of the holding company. I have no doubt in my mind, and I don't even have to speculate, that it's a matter of time that this regulation will come in because I know the views of the government on this aspect. And I've had many discussions with the former MCA secretary on this. This precisely is what you are asking, that eventually, if this comes in, then that requirement will become mandatory. Okay. Are independent directors really knowledgeable and serious about their role and responsibility? Let's not look at the top 100 companies in India, but remaining a lot. But perhaps you could be right, whoever has asked this question. There is certainly a lot of scope for enhancing the quality of independent directors. I think it could be extremely judgmental and speculative on my part to make a comment that they are not really knowledgeable or serious about their role. I know for a fact that many of the independent directors who considered board meetings as a responsibility to attend are now far more responsible in terms of reading the minutes, understanding it, and then going to the board meeting and asking the right kind of questions. So there is certainly a shift on that. But I don't know whether I can really answer your questions, whether they are knowledgeable and serious or not. Suffice to say that there is a lot of scope of improving the quality of independent board members. How can board members get to know enough about the business to add value without getting too involved in the operations or becoming intrusive? Excellent question. I think different companies follow different philosophies I have been very fortunate to be on the boards of few companies where I finished my term, and some of the companies that I've joined in the recent past, in the last year or so. There is an orientation, like an employee gets an orientation, like a KMP gets an orientation. The board member should also get an orientation. I also feel that a lot of responsibility lie on the board member as well to seek the right kind of information, not just at the orientation stage, but even on an ongoing basis. You don't need to wait for the board meeting to ask questions. You don't need to wait for the agenda of the board meeting to ask questions, to pick up the phone. Because at the end of the day, the independent board member is not working as a outsider. The independent board member is supposed to be working with the management as a team. In fact, the independent board member is far more closer to the business than the auditor, because an auditor is supposed to be wearing a lens of review and performing that function. That is not what an independent role director has to play a role. So I think whether an independent director adds value or not, besides the quality of the board that you are going into, it also a lot depends on the independent board member as to what kind of facilitative role they want to play. I agree that the independent board member's responsibility is not to be involved on the day-to-day operations of becoming intrusive. That's not the role of the independent board member. It has to be a balance. There, I have seen some independent board members getting involved in signing checks, and they've landed themselves with criminal proceedings under the Negotiable Instruments Act. But that's a mistake. That is not an independent board member. Now, whether the independent board member has done it out of his own or the company expected him to do, it's first a wrong thing to do. So I think that this is a balance that you have to strike, where you ought to make an effort to understand the business of the organization. You ought to ask the right questions, and you don't have to wait for the board meeting to ask the question. And you ought to make an effort to keep yourself abreast with the organization. I must tell you that I used to be on the board of a very large multinational which was in the healthcare business. Even as a lawyer, though I don't practice outside of the tax law, I did not realize that there are over 100 statutory regulations on the food law at the state and at the central level. Now, that doesn't mean that I have to become an expert, but I ought to know what those regulations are, which are the important products of the company where I'm sitting on the board, which get impacted by the law. What are the consequences of that on the factory manager, on the key managerial personnel, on the board? Let's take a case of an FSSI law, the food law. It's different in different states, right? And even the best managed boards such as Nestle got impacted because of the Maggi controversy. It's a different story that the Bombay High Court came and validated Nestle's position. But Nestle went through very, very difficult times to be able to deal with that situation. Now, so it is very important for you to get to know the regulatory environment surrounding the business of the organization where you're on the board.
So I think Manish, the questions are over. So Mr. Butani, that was an excellent session that we had, and the in-depth understanding that the audience today has got. And as you would have noticed from the questions, that the audience is absolutely into this. Maybe they're very, very senior people who are sitting in the audience, and they have the right perspective. And so your vision has really been of great help. I would now request Manish Bhai to propose a well-deserved formal vote of thanks.
Thank you, Doshi Madam, again for giving me this opportunity of doing this pleasant task. So all the participants will agree with me that the session taken by Mukesh sir was really, really, really excellent. He has explained everything in such a lucid language with the case laws and with the live cases and shared his experience So really it will help all the participants to understand and take care of the situation whenever they face this kind of situation. So with this, I request all the participants wherever they are sitting to carry with me a vote of thanks with loud applause. Thank you, sir.
Thank you very much for inviting me, and I really enjoyed it. You wanted to add one thing that chartered accountants have a very important role to play, not just in their wearing the hat as an auditor, but I know many chartered accountants man board positions, including myself. I think I would not have been an effective board member, and I find myself lucky to be equipped with the chartered accountancy qualification and experience to be able to shoulder this responsibility. I also feel that the future of boards will have a lot of chartered accountants, not just manning the audit committee, but other boards as well. And hence the profession has a very important role to play in the board dynamics. Thank you very much.
Thank you, sir, for being here with us and sparing your valuable time. Thank you very much.
Thank you, Doshi. Bye. Thank you, Manish.
Bye-bye. Okay, so now we can move on to the next session. Again, with extremely illustrious panel that we have with us. We have been really privileged to have with us this extremely illustrious panel, and we have CA Anand Bathiya, who has played a big role in, making this possible, this entire program, and I give a lot of credit to him. And we have him as a moderator for the next session with this dynamic board members, and I think we'll be able to ask these panelists excellent questions, and I'm sure there'll be more that will come from the audience. So I would first like to introduce Anand. He's a good friend of mine, and here he is also a practicing chartered accountant. He has worked with leading accounting and professional consulting firms. He's a fellow member of ICAI and has completed his final examination of company secretary course also. He's a bachelor at commerce and bachelor at law with a postgraduate diploma in securities law from Government Law College and information systems audit from ICAI. As partner and practice head with Bathiya and Associates LLP, he is engaged in advising businesses in negotiating, structuring, performing due diligences, and executing domestic and international mergers and acquisitions, having advised more than 200 M&A transactions over the last 15 years, including a few of India's largest M&A transactions in recent times. He has enabled businesses to raise equity resources through public equity and private equity, including capital market initiatives of IPO, QIP, right issues, open offers, international listings, etc. He specializes in advising private equity funds and family offices in formation and fund documentation, diligence, and investment transaction execution. He is a managing committee member of BCAS and co-opted member of a group promulgated by the Valuation Standards Board for drafting valuation standards to be made applicable in India. In fact, they are applicable. He represents as independent director and audit committee chair on boards of listed companies and favors playing cricket and chess in leisure time. So here we have a very interesting personality in young and dynamic CA Anand Bathiya. And I would request now Anand to take over and introduce the panelists for the evening. Thank you, Anand. Over to you.
Thank you. Thank you, Drashtiben, for that kind introduction. And good evening, everyone, for choosing to spend your precious Saturday evening with us, the panelists as well as the participants. I'm sure given the assortment of panelists that we have today, it will be worth our time over the next 90 minutes that we are going to talk on this panel. Friends, the topic for the discussion that we have today is on how does one make sure that boards are effective, and what are the ingredients that go into making boards effective. And we'll talk about the sensitive aspect of conflict management at a board level as well. Before we get into actual discussion, let me take the pleasure of introducing the panel. Of course, the panel needs no introduction in the fraternity and the participants that we have here, but let me quickly and crisply introduce the panelists that we have today. We have past chairperson of WRC, CA Bhavna Doshi, a big partner with Bhavna Doshi and Associates, involved in fields of taxation, corporate restructuring, advisory for the last 30 years. She has been a chartered accountant, rank holder, both at intermediate and final, and one of the early lady chartered accountants to have a rank distinction at the final level. She, of course, represents as independent director on boards of many companies and also has the prestige of being president at the Indian Merchant Chambers and actively associated with the activities. Bhavna Ben, it's a pleasure to have you here, and we look forward to your guidance and thoughts on the panel. Mr. Ketan Bhai, of course, all of us know Ketan Vikamsey. Ketan Bhai is a partner with Kimchi Kovarji and Company, one of the very reputed and audit firms in India. Ketan Bhai heads the assurance practice at Kimchi Kovarji and Company. And Ketan Bhai is also a director on State Bank of India, which is India's largest bank in terms of its loan book. Apart from that, Ketan Bhai is also independent director on other companies, including Metropolitan Stock Exchange, Atlantis Investment Advisors, HLB Technologies, and the list goes on and on. I am also a particular fan of Ketan Bhai's photography, both in terms of wildlife and in terms of nature, and lots to learn from you, Ketan Bhai, on the panel and otherwise. Mr. Nawshir Mirza, again, sir, you don't need an introduction, but it's a pleasure for me to say a few words. Independent director on the board of Thermax Limited and various other Tata Group companies, Emphasis, Exide, and involved in improved corporate governance in the corporate sector since 2003. Mr. Mirza is a fellow chartered accountant in India, having worked with SR Bartley Boy, Ernst & Young in the offices at Kolkata, Mumbai, and London. He strongly believes in humankind taking responsibility for destruction of the natural world. Nawshir is also on the board of Energy Resources Institute, among other various NGOs. Thank you, sir, for joining us on the panel. And last, just in terms of alphabetical order, Dr. Uday Lajmi. It's a pleasure to have you as a non-CA representative on this panel, and it just brings the diversity and inclusiveness into the whole discussion. Mr. Uday is PhD in physical chemistry from University Department of Chemical Technology, Mumbai, and also has a master's degree in marketing management from University of Mumbai. During his professional career spanning 23 years, he has served Hindustan Door Oliver Limited, Reliance Industries Limited, before taking a full-time academic position as a reader in marketing at Wellinger Institute of Management, Narsi Munji Institute of Management Studies, and as a dean of D.Y. Patil Institute of Management Studies. The list just goes on. And sir has also been an independent non-executive director on MT Educare Limited and other companies. Thank you, Mr. Uday, for gracing the panel today. With this, Bhavna Ben, let me, maybe pick your sense first on the effectiveness of boards or making boards work. And to a large extent, it is the composition of board that will ultimately result into how effective the board is. Because as we say, garbage in, garbage out, maybe good composition would also mean that there is good effectiveness logically. Now, earlier in the session of Anup Bhai, as well as Mr. Butani, we saw that regulatory, there is a lot of framework in terms of what should be the composition. But that is maybe from the mindset of minority shareholder protection, that you need to have X number of independent directors, one CA, etc., etc. But from the effectiveness perspective, when we are moving from a minority protection shareholder-based regime to a stakeholder-based regime, what in your view should be the ideal composition of the board or must have ingredients that go into composition of a board?
Thank you, Anand. And it's always women first, right? So
Absolutely.
Let me now answer your question. Yeah, what you said is that yes, there is a regulatory framework which requires certain independent directors, a chartered accountant, and so on. But a diversified board is generally very, very effective, is what I have experienced. And when you say diversity, it's of course one is the gender diversity, which is what is also now mandated by the regulations. But besides that, what I found is that even geographical diversity, also the domain knowledge diversity, makes a lot of difference in effectiveness of the board. So I sit on some of the boards where I find that because of the new directors whom we are bringing in, who have specific domain knowledge or they are from different geographies, it's really helping in decision-making process. So I believe that yes, the diversity definitely helps in a board, and different perspectives come in because you have diversity. So depending on the nature of business that the company is, you need that particular knowledge base, which is very, very critical. So besides our traditional finance, law, accounting, auditing, we also now have many more people from different fields who are joining the board or who are, in a sense, invited to join the board, and that's really helping the effectiveness of board.
Sure. Mr. Mirza, a pointed question. If you had to, like a cricket team, a board composition, apart from the what would the board be?
What would be an ideal board composition? Okay, see, an ideal board composition should be, as Bhavna said, as diversified as it can possibly be. But if I can, before I answer that particular question, just go back to your earlier question to Bhavna. See, a lot of how well a board performs is how well the chair lets the board perform. And if there is an influence on the chair by someone behind the chair, then it depends on how that person behind the chair influences the chair to conduct himself. This is true whether you're talking of the public sector, you're talking of a family company, you're talking of a multinational, because I've sat on no public sector, I would never sit on a public sector board, but I've sat on multinationals, family companies, so-called professionally managed companies, and inevitably, the fact has been, how does the chair let the board perform? I'll give you an example. I was on a board where the chairman is an outstanding individual from outside of that board. And if I had not seen him in the board, I would have had the highest of regard for his what kind of presence he has in the board. And he was the chair of the board. He's not a promoter. But he was completely under the influence of the promoter, and in the board, meetings would be run so that they concluded within 30 minutes. And you could clearly see that this individual is not that sort of guy. I'm sure in his day role was doing things differently. But in that board, he would not suffer much discussion. Everything would be speeded through. Yeah, indeed, in that particular company, after my first 5-year term, I refused to be reappointed because I found there is not much point being there. So a lot depends on the chair, and ultimately a lot depends on who influences the environment or the atmosphere in the boardroom and the kind of conversation we can have. Going back to your question as to what would be an ideal board, like an ideal cricket team, and it always depends on the business you are in. It depends on the stage of the business you are in. A startup would need a different kind of board from a mature company, would need a different kind of board from a company which is approaching its last days. And so in all of those, you will need different kinds of board. So in the classical trick, I won't really answer your question by saying it depends. But what I would say is that the one thing you need in the board, in all of the directors, ideally, is an element of wisdom, that they bring wisdom into the board. And my own experience, Anand, has been that a lot of directors bring a lot of transactional knowledge into the board. So when you sit in the boardroom or you're having lunch or something and you hear the conversation everyone's having, they know all about who's recently been moved into MD of this company or which company has just raised money from the Canada the fund or something or the other. They're all very transactionally clued in. Very important. You need to follow that. Wisdom means able to look into the uncertain future and see how what we are proposing to do will impact the business. And I think even if there are one or two wise men in that room, it's good. If there are more, you're very fortunate. So I will answer your question a little roundabout. And so to a certain extent, it does mean you need somewhat older people too. That's why you see the panel. Everyone here is, I assume, over 50, even though Ketan doesn't look it, and Bhavna never will be as a lady. But all of us are, because it's assumed that if you've gathered a lot of life's experience, hopefully you've picked up some wisdom. Not necessarily true. But if you're far too young, you may not have had enough experience to be wise. You may be extremely competent transactionally, technically. You know all about accounting standards. You know all about the latest stuff. There's not much needed in the boardroom. So that is the kind of answer I've given to you.
Yeah. So Ketan bhai, just jumping to you, like Bhavna Bin said, diversity is one of the ingredients. Mr. Mirza said domain knowledge, independence, and maybe a bit of gray hair are something that helps a board become more effective. Now, the independent directors, Ketan bhai, as a stark contrast, there is a data bank now. And it's possible for independent directors to then apply for that data bank, and management can pick and choose from them. Now, when the requirement is so diverse and there is no one size fits all, how does that independent data bank think and that whole structure work in your thought process?
Sorry, I just missed the last sentence.
Yeah, so this entire thought process behind having an independent directors data bank, and then management's being enabled to pick up from that and have them appointed on the board, does that somewhere not make it a straitjacket approach rather than something that is required in a board to make it more dynamic and more specific to that company?
First of all, let me thank the Western India Regional Council for giving me an opportunity to be here and share my thoughts with and share this dais with this August panel. And to you, Anand, for basically, first of all, shifting your portfolio from a panelist to a moderator. But I would suggest that your views also would be equally welcome on the questions which you are posing as the other four of us. Coming to the independent directors panel, which has been set up by the government, well, it's a good initiative, and to bring when we go through it to give us the names of people, but eventually and finally it is not the proficiency of the profile which would give a good independent director, and it would be more a matter of the maturity of the person and the wisdom of the person which would make him a good independent director. And to come back to the question which you first put to Bhavna Ben, I believe the right kind of a mix would be the balance between the people who come with the right brain and the people who come with the left brain. The left brain is essentially for people like us who are on the panel, more analytical, more logical, more disciplined, more methodical, and the people with the right brain who are more creative, who think out of the box, and who are more artistic in approach. So I believe that would be the right kind of a mix which would essentially, take forward the board in the accomplishment of good governance of a company. To take it, essentially what the board wants is the company goes on to the next level or to the next platform. And to my mind, that would be the right kind of a mix which would take the company to that next orbit. And as you rightly said, that there are regulations to put in place. There is a finance personnel or a finance expert who would take care of the audit committee, and similarly for the other committees. But I believe with the technology and digitization of the entire globe, it would be very essential now to have a person of technology separately and a person of digitization separately on the board to take the company on the next level.
I think Anand's screen is frozen.
Yeah.
So,
I think we temporarily lost him. Maybe the moment he gets some network, yeah, he'll be back.
yeah.
Am I
So,
audible?
Yes, Anand.
Okay. Okay. Sorry, some network issue at my end maybe. Mr. Lajmi, if I can, take some thoughts from you in terms of board composition. When you look at a particular board composition, what are the signals that you look for that makes you feel comfortable that yes, this board is effective?
First of all, thanks a lot for inviting me to be on this panel. I heard to Bhavna Ben initially when she made her comments. Then I heard Nawshir Mirza, Mr. Nawshir Mirza, and Mr. Ketan Vikamsey. I have come from a background of education and corporate experience, which were filled with stalwarts, and such stalwarts who were also academicians. And Bhavna Ben would definitely know, with Reliance background, that Reliance Industries has one of the finest chemical engineers on the board, and for many years, and he has been guiding India's #1 corporate house for many years. What I have seen through my example, through my experience, is that uh, a fine technologist or a technocrat with a deep sense of economics, is a good recipe for an independent director. And it has proven through, best of the corporate houses who have such independent directors. You can always engage Mr. Anand Bathiya. You can always engage technical people as consultants. But to be on the board and to look at the future, and I come from a college which has actually shaped one of India's finest, chemical companies. I don't want to name, but then you can guess. And also one of my seniors, he is the chairman, managing director of that company, including another executive director who's also a student of Udacity. But the fact still remains is that Anand, which is common among all the panelists, is that technical skills are definitely a winning advantage for any board, but without a vision, without the sight for future, how the businesses are moving, particularly the company in which they are on the board of directors. Uh, because I've had experience with one company, and we have seen the ups and downs of the coaching sector, particularly the education coaching sector. It has gone through a lot of ups and downs, and what we see after the pandemic, we had invested a lot of money in online education. At that time, we came up with products, and we spent a lot of money, lot of energies. Most of our people were engaged in automating, and making education easy for students to study at home, when today it is actually a new normal, Mr. Anand. So what I'm saying is that those companies which have already engaged and have set up good models for board structure and board formation should be, followed by other companies to, bring in value for those businesses. That is what I want to say, and more can be spoken after, you expand this panel discussion. Thank you all.
Sure. No, absolutely. I think, yes, Mr. Mirza.
You must unmute your mic, sir. Yeah.
Forgive me. What Uday just reminded, you talked about your old friend Doc Marshalkar, and we used to both sit together on a board, and Ketan said left brain, right brain. And in that board, it used to be a standing joke. Doc Marshalkar is a die-hard, or never say die optimist, and Nawshir Mirza, who's been an auditor all his life, is a die-hard pessimist. So we have a perfect balance in the board with one, not the left or the right brain, but a super optimist and a super pessimist.
Understood. Also, sir, one very interesting thing that I noted, Mr. Mirza, in your brief or your introduction was the designation of professional independent director. Now, most of us generally think that, yes, we are in the practice, and independent director is the left-hand thing which we do on boards, and add that outside-in perspective. Do you think that time has come to have more professional independent directors rather than also ran independent directors?
Well, Anand, I was in the profession 36 years, and I got bored of doing auditing. I'm sorry, Ketan, but I really got bored of it. So at the age of 52, I resigned, and I said I don't want to continue anymore. I can't see myself another 8 years doing more auditing. It's just impossible. And then what will I call myself? So I called myself professional independent director. And just at an event yesterday, I was introduced as India's first professional independent director. That's only because I'm the first guy who called himself professional independent director. But yes, I don't see any harm in that. And it's stood me in perfect stead, because other than about 2 weeks every quarter, when I have a lot of work to do, I have another 2.5 months when I'm at liberty and free to do all sorts of things that please me. And yes, if I want to make more money, maybe I don't want to give up my art for the rest of my life. But you make reasonably good money as a professional independent director. That is a question in people's minds. I don't think companies pay you very poorly now, but pay you reasonably well. So there is no harm. And there is a lot of work you can do as a professional independent director. You can yourself develop so many tools. I have developed about 15 or so tools that you can use in audit committees. And I give them away to anyone who wants them. It's not my private use only. So you can do a lot of development. You can do a lot of personalizing and make people hopefully become better directors. We try to do that. Bhavna has many times tried to give me that opportunity in her merchant's chamber role, and I will be privileged to take that opportunity. So yes, there is scope for that. I see absolutely no reason why that shouldn't be happening now.
Yeah.
Anand, if I
yes.
I fully agree, Nawshir. I fully agree that it's a good idea now, considering the complexities, the time that a director is required to spend. The independent director also, now the expectation is that there should be many more meetings. You should informally interact with the management, interact with the other board members, also interact with understand perspectives, and what we discussed in the earlier part in terms of diversity is to people also need to understand what's happening outside and how you can add value to the board you are sitting on. So therefore, there would be no harm if we have full-time independent directors. Though today in our country we have yet reached that stage where a person can say that, okay, I'm going to do only independent directorship and nothing else. But I'm sure time will come when we will reach that stage. And today, what's happening is when you do some other work, not so much, but some other work that also keeps you abreast with the latest developments. Keeping up with the developments is really, really very hard. So,
Yeah. I think one thing that is very clear, Bhavna, is that even from a regulator's perspective and from an ideal board perspective, it's important to have the right balance between right brain and left brain, or between promoters and independent directors. The better balance is also striving to be achieved in terms of gender diversity. There is, law mandates that now there should be one woman director on the board. It's been 3 months that we have been into that experiment. What is your learning? Has that been effective in terms of the Indian context?
essentially, I mean, independent directors, independent directors, whether the person is a man or a woman. Perhaps government wanted to do it to give more opportunity to women so that they become more and more involved in different roles. But I feel that having a woman independent director on the board certainly helps. Of course, they bring in their own perspective, and by and large, they are all people with knowledge and variety of things in the sense the basic education and whichever area they represent, whichever is the knowledge. But it also makes a difference in terms of overall development of the organization. Women generally tend to pay more attention, and therefore we would look at a variety of areas. For example, when I joined one of the boards, the number of people at the senior level were very few. Women were very, very few because generally at the lower level there are many women, but thereafter they do not come up. So as women director, as a woman director, what you do is you do ask questions that why, what are the policies, what are you doing to ensure that more women come up, what are the measures that you are taking to help them grow, develop, so on and so forth. So I feel that it does help overall participation of women in the economic activities of the country, and that would certainly, yesterday only somebody was telling me that if more women participate in the economic activities of the country, it helps countries' GDP grow up significantly. So definitely there is merit in that. That's what it has helped.
Yeah, absolutely. And now the proposal of having woman independent director, potentially whenever that gets passed, will even have that. Ketan, all of us are chartered accountants over here, other than Dr. Uday. Tell me, as a chartered accountant on the board, is there a particular edge or a strength that we enjoy as an independent director or as a executive director? How do you rate a chartered accountant on the board of a company?
Yes, definitely. As a chartered accountant, you have a sharp edge when you sit on the board. But before that, let me touch upon the last question that you put up to Bhavna on a woman director. And I would share my experience of having a woman director or a lady director on a board of a company or an organization. And we, as I said about the right brain and the left brain, so also we need to talk about the head and the heart. And essentially, people, the men are more head oriented. They are the women who are more heart oriented, and they think from the heart, which gives a good balance to the decision making process of the board. And my personal experience with women directors on the board is number one, they have very sharp memory, so they are able to recall from a earlier board meeting what was the actual decision, what was taken, or what was the deliberation that had transpired during that board meeting, and what impact that has on the current discussion that is happening in the board. So which sometimes we as men tend to miss out. So that's a very important feature or a very important character of a woman, which I would distinctly remark. As I said, they are more balanced decision makers. So it's not necessary that the woman or the men who are sitting on the board will have all the expertise that are required to run a company, or all the expertise that is required for a board to take a decision or a judgment on. But having taken the views of the board members sitting across the table, I believe it is the women directors who are more, capable to distinguish between the right and the not so right, and come up with their own decision or a judgment which would be in the interest of the organization. And as Bhavna also said, women directors are more disciplined and more punctual. So definitely these are the traits which we look forward on the board from any good director who would be on the board, irrespective of whether he is independent or he is executive, he is in the executive or a non-independent director. Coming to your question on whether a CA would make a good board member or an independent director, yes, definitely. As a chartered accountant, I would say, and there are distinguished panel. Of course, Mr. Lajmi is, I should say, he's a semi-CA because he would have trained so many chartered accountants in his college, be it in different capacities. So the basic benefit that a chartered accountant comes with to sit on the board is his immense experience of handling various businesses or various in his advisory capacity or in his audit capacity. So as an auditor, you are dumped into a coal mine and said that, okay, you do the audit of a coal field, or you are dumped into a gold mine and do the audit of a gold mine, or in a manufacturing company, a finance company, an insurance company, a bank, a mutual fund, be that as in a pharmaceutical company. So when the auditor, and one of the auditing standards says that understand the business. So as an auditor, when I go to audit a company, first, what I need to do before I start my accounting standards, I need to open up my auditing standards and understand the business. And that is what I practically do. If I go to an industry or if I go to a manufacturing company, the first thing that I demand is that I would like to visit the plant and understand the entire process. So that is the immense experience with which the chartered accountant comes and sits on the board. Of course, as Mr. Lajmi rightly said, that it is not the technical knowledge or not the proficiency or the good profile which makes up a good board member. So definitely, along with the experience and the qualification, you have to have your wisdom and maturity, which you bring on board to make a good independent director. I would like to leave it to the other other panelists also to throw light on this aspect.
I think Dr. Uday, sometimes overemphasis on accounting and professionals is also detrimental to the diversity and the inclusiveness. One becomes slightly myopic in terms of execution and compliance and tax benefit, rather than looking at a 40,000 feet strategic objective. What is your thoughts in terms of having too many financial people?
Mr.
Mirza, if you can yourself.
There was one point which I would like to bring in right now is the understanding of the policy framed by the government in specific businesses. And very few people, have read the policy documents and tried to understand how we are aligned to that national policy, That was one point which I thought I should bring into this panel discussion, because understanding the policy and aligning our businesses should be one of the activity of the board members to see whether we are aligned to the national policy and whether we are doing enough to the national mission. Point one. Point two, though we talk of corporate social responsibility, most of our companies really do not understand the meaning of corporate social responsibility. being a part of one of the firms as an independent director, I remember that we did a lot of work in adopting municipal schools. When we know that municipal school attendance was ebbing, there were hardly any students going to municipal school. The national policy, education policy today talks of primary and secondary education, how to bring more and more children to primary school. And that is precisely, as a company, we thought we should, allocate some of the funds to adopt these schools and try and get children to these schools. The point I'm trying to make is that understanding the policy and aligning, you may be any size company, you may be a medium-sized company, you may be a large-sized company, but your corporate social responsibility towards nation building. So many statements are being made, Anand Bhai, about capacity building. And I'm talking of big sectors, very large sectors. Bhavna will also accept it. We do not have enough technical people even in power sector. Power distribution, power transmission, power generation. And so much of money is being spent to train, but people don't want to join that sector because the sector doesn't pay, Anand Bhai. People would like to sell soaps, people would like to sell fancy FMCG goods वगैरह वगैरह, मगर लोग नहीं आना चाहते हैं ये सेक्टर में. तो ये और एक मामला होता है सर कि how to bring good engineers, good technologists, including good teachers. At IITs, you'll still find positions vacant. It is difficult for UDCT to get good chemical engineers as faculty. It is difficult for Indian Institute of Science to bring in good researchers back to this country to have good research facilities in India and to continue with the research mission. But the fact still remains that aligning with the policy is one point which I thought I should bring to this table. As independent directors, we must read the policy statement. We must try and understand that our businesses should be aligned, whether we are contributing as a business and towards nation's capacity building is what is a major point which I thought as an independent director should drive any business towards that end.
Point taken, sir. Mr. Mirza, while we are saying that board needs to be effective and here are the ingredients to make the board effective, it's not a milestone. It's a moving target where you continuously keep on seeing whether boards remain effective or not. And that is where now it is mandated by law to do annual board evaluation and see whether every director is contributing, skill sets are matching, and all those things are there. But what we are seeing is that it is more becoming a check the box exercise rather than yielding into anything meaningful. What has been your experience and sense on this entire board evaluation framework that has come up?
It depends, Anand, on the company. I have sat on companies where I have run the evaluations, and these are large companies. For example, Tata Power, for many years, as the chair of the NRC, I used to run the entire evaluation process, and that needs to be done in a thorough, professional manner. I have sat on boards where, as the person who ran the assessment, I would have to go and tell the chairman of the board, Chairman, the board feels you need to lose some weight because the board is concerned that you will have a heart attack, and we cannot have the chairman of a major company suffering from being incapacitated when the company is in a critical situation. So there are boards which do that sort of thing. So I've sat on the boards of companies where the persons being evaluated actually sit in the room and wait to be evaluated, where the entire exercise is a pure formality. And it's not because the independent directors are wanting that kind of thing. It's because the entire environment in that corporation's board is all these things are a waste of time. Let's just get on with making money. And those are the kind of boards which don't spend too much time on discussing strategy, because Babuji knows all about strategy. He's already decided what the company will do. So why waste the time of Babuji and the board and tell them about the company's strategy? What will they be able to say? So those are boards which the meetings last 1 hour or so and they go. And so really effectiveness of the board, and I always say the effectiveness of directors. I think there are only two real roles directors have, certainly independent directors. There are just two real roles. I reduce it to that. The first real role is being the voice of those people who are not represented already in the room. That means not the promoter who's always represented. He sits there like an enormous presence, even if it's just one individual. He fills 90% of the chairs in the room. More or less, if he's an honest promoter, he represents all of the shareholders. Generally, the employees are represented. Very few businesses can succeed by ignoring their customers. But all of the other stakeholders are not represented in that room. And it is for the other directors, and certainly the independent directors, to be the voice for those stakeholders. And there is one stakeholder who is the most important and is not adequately recognized, and which is future generations. Because a lot of things companies do today are going to affect our children, our grandchildren, our great-grandchildren, perhaps for 100 generations. And it's a very important stakeholder which has no voice because the stakeholder hasn't even been born yet. But you have to represent that stakeholder. So the first role is being the voice of those who are not in the room but are being affected by whatever the company does. So that's the first. And the second is to challenge management. Because see, the role of management, the role of any businessman is to be an optimist. If you're a pessimist, you can't do business. You have to be optimistic because that's why you do business. And if you're an eternal optimist, like my friend Ram Mashirka, then we have a lot of companies which didn't have sufficient pessimism in the board, which are today all lined up in the IDC process. They're all companies who thought they will become the biggest very fast, who borrowed more than they could ever have managed to tackle. They're all in the IDC process today, if you go down ultimately. And I said, what were those boards doing? Managements were optimists, the promoters have to be optimists. The rest of the directors have to bring the as it were, the measured or balanced, constructive pessimism into the board to stop, press the brakes when things could be going wrong. And so the real test of an effective board is that. And that is something which generally chartered accountants, particularly if they've been auditors, and I said that a few minutes ago, are good at. Because the auditors tend to look at always the dark side, the underbelly. But Mahatma Gandhi called the drain inspector when he talked about that book, Mother India. Yeah, so the auditors tend to be drain inspectors. They're always looking for the dirt and the mark. But those are positive because then there's a yin and a yang in the boardroom. If everyone's cheering the management, why have any directors? Because the management is already cheered itself. Let them all stay at home. They don't need to come. So I'm not a believer in directors being optimists.
Sure, understood. Ketan bhai, you have been on board of blue-blooded PSU bank like a SBI, and you have also been on board of family-run promoter entities. What has been your perspective on board evaluation? Is there something different that both of these kind of entities do? What's the sense on board evaluation that you would like to share?
So, as Mr. Mirza pointed out, it would essentially depend upon the NRC chairman to, run this entire process of board's evaluation. I would see it more as an introspection rather than, assessing the capabilities of my other colleague. Based on there is a questionnaire. So based on that questionnaire, I would like to see as to where I stand on a rating of A to C or A to Z. and where are the avenues available where I can improve upon those particular skill sets which are probably lacking in me, which are more seen in another colleague of mine sitting on the board. Since the evaluation has to be done and given to the NRC, where I have seen is it doesn't go to the company at all. It rests with the NRC chairman. And I believe, I would go on the wisdom and the maturity of the NRC chairman to keep it confidential to him. The board, once that confidence is given to the board members are free to give their independent evaluation to the chairman and take it forward from there. But somehow I would still look at it more from an my own perspective as to where I can improve, rather than to look at improving or giving an opinion on the colleagues who are sitting on the board.
Yeah, so it's more of a self-appraisal rather than a peer appraisal that usually would help, especially at a board level. Bhavna Ben, so we are talking about diversity, and we are talking about yin and yang, right and left, head and heart. Isn't this a real ingredient also for a conflict situation? Because while we want diversity to bring out inclusiveness and efficiency, if not handled well, these ingredients are fit for a conflict as well. So how does one, make sure that yes, there is diversity, at the same time those don't yield into a potential conflict at a board situation?
Or help in resolving the conflicts which could arise probably. But I mean, conflict management itself is a very specific area, an area which is sensitive and which also needs to be handled very, very carefully, very, very cautiously. And everyone would have had examples they can share. Like, for example, I was on the board of a company where despite there being profits in the company, cash balance is available, the cash balance would be held always in a bank account, which would give only a certain rate of interest, only a certain type of bank accounts, and the cash balance is sitting there. So first year, good profit, no dividend. Naturally, shareholders made a lot of hue and cry as to why no dividend is being given. We were told by the management, and in that company, the promoter was not represented himself, but he had executives who were sitting on the board. They would explain that, we have just come out of a situation of loss, so we need to conserve cash. Fair enough. Second year, good profit, no dividend. Third year, no dividend. So at the board, we said, this is not right. I mean, there is conflict of interest because perhaps the majority shareholder is not interested in dividend, but minority is interested. And that's where we said, why no dividend is being declared? I think and both of us independent directors, we said, you must consider dividend. The management was hesitant, the executives were hesitant, the foreign company executives. And we perhaps felt, we had a discussion internally, and we felt that perhaps they don't want to declare dividend because they would have higher tax exposure. They don't want that money. Yeah. Then, of course, the shareholders raised big hue and cry. So then the management and the foreign management, they told us that, we would like to explain something to you. And they made a very detailed presentation on what they think is business likely to be in the next 5 years. And when we saw that global presentation and how the markets are expected to change, they said that's the reason we need to conserve cash, because otherwise next year we'll be in severe difficulty. And exactly that's what happened. The next year was loss. Year after that was worse. But because the cash was conserved, it helped. Now, there was a conflict. The minority shareholders' interest, and we felt it was majority, though they were not really majority, they were more of a business interest. And there are several situations which do arise, whether it's between the management. Sometimes we find that the management and the promoters are not aligned. So that's where the challenges arise. Sometimes within promoters, there are challenges. It's several situations, even where it is single promoter also, sometimes there are challenges. So conflicts of interest, which we all have to deal with. but one has to draw a balance. And the fact that we have a diverse board always helps, is what I have found, because people bring in different experiences, different perspectives, and are able to put it across together. And that's where I think even the separate meetings of independent directors and this whole evaluation exercise helps a lot. In my experience, it has helped a lot in several situations.
Yeah. So, Bhavna, I think the theme that you are saying is effective communication, and putting yourself in the shoes of the other side will kind of maybe help to some extent to manage conflict better. Sounds very similar to marriage. All of us would can relate it much better. But Ketan bhai, coming to India has this unique animal called promoter. Now, typically, if you'll see, you'll have shareholders, then you'll have board who is governance, and then you'll have management who are actually doing the day-to-day operations. Here is a person potentially who is a majority shareholder, who sits on the board on the governance, and as well as the MD or CEO of the company. So that is very unique in terms of how most of the Indian companies or family-run businesses see a promoter. Do you think working on family-owned businesses that this particular is one of the basis that there can be potential conflicts because there is no clear demarcation, and this person cuts through all the three veils in that sense?
Good question, Anand. Although we say that Indian companies are more promoter driven, across the world we find that barring the large companies, all the companies which are much larger than the largest company in India are also family driven, maybe in the Europes of the world or the Americas of the world. So it's not necessary that a promoter driven company is not a well managed company, or the promoter would always say that it is either my way or highway. What I feel is it depends upon the maturity of the promoter, the vision what he has, and the long-term perspective that he carries for the business, which would eventually drive the company and which would motivate the board to come together, put in their brains for the progress of the company. So, to give an example, in the short run, the promoter may look at the profits because it's a quarterly results. The quarter-on-quarter results have to be positive. They have to be growth-oriented. They have to have a particular direction in which the market looks at the company or the results. So those all compulsions the promoters are coming today. And to top it all, they have advisors or the in-house employees who look at the investor protection, or not the investor protection, but the investor welfare, or the investor look at the investor the performance. So they are the ones who give the compulsions to the promoter that we have to have the results in this direction, or we have to have the growth of the company in this direction. And that is where the promoter is quite carried away with. In case of a challenge during a particular quarter or during a particular year, the promoter, is compelled to look at ways which are different than what the actual tangent of the company is showing. The board can come together and convince the promoters that this is not in the long-term interest of the company, and he may be probably take it with a bitter pill. He take it as a bitter pill, but if he is able to overcome that, and in the long run he is much more a relieved person, much more a person with a person who can get a good night's sleep, he eventually would thank the board for having geared him in the right direction or steered him in the right direction. And I don't look at it as a conflict. It could be a conflict in the short term, but in the long run, it is all in the interest of the organization. Well, it is more a matching of the wavelengths rather than a conflict. Say, for example, if there is a board where only chartered accountants are sitting, do we see that there won't be a conflict? Well, there is no diversity, but there could be a conflict in that room also. So it's not that diversity brings in conflict. The conflict could be at any point of time, but it would be the maturity of the board who is sitting there, or the wisdom of the collective wisdom of the board, who would steer the company or who would guide the promoter in the right direction in the interest of the company, which can overcome these conflicts.
Appreciated. And Mr. Mirza, conflicts can happen at various instances. It can be between an independent director and a management. It could be between promoter and a regulator, or sometimes it could be between two promoters also. And you have been maybe on one of the boards where two set of promoters had a not so good relation between them. And sometimes as independent directors, we are at a crossfire. How has that situation been, and how do you deal with that? You'll have to unmute yourself, sir.
When I should be muted, I'm unmuted, and vice versa. Okay, the audience mustn't have got the impact of what you were asking me. So I think Anand is referring to my time on the Tata Power board when Ratan Tata and Cyrus Mistry were fighting like dogs in the street. And they still are fighting, perhaps with a little more grace, certainly with not as much disgrace as then prevailed. And I was in a very unique situation at that time because when I was on that board and this whole dispute began, we had just had 4 of our senior most independent directors retired. And we had 4 new independent directors who had joined and had not yet actually come to any meetings. And they were going through the induction course when Cyrus Mistry was removed from the chairmanship of the company, or an attempt was made to remove him from the chairmanship of the company. So I and my colleague Deepak Satwalekar were the only 2 surviving old directors on that board. And we had these 4 new ones, and we had a nominee of LIC and people like that. And it just so happened, because of this particular transition happening, that I was then chairing both the NRC and the audit committee, which are the 2 almost the 2 remaining parts until if you don't have a chair of the board. So when this happened, the first thing I realized that there is a certain obligation upon me, because the CEO, he left the company, splendid gentleman called Anil Saldana, and who would Anil turn to? Because the CEO needs to refer to someone when he has issues, and he normally refers to the chair. And there was no formal chair. Second, in this situation, he needed to refer even more, because this was not just business issues that have to be discussed. There were major issues. So I basically found myself in that particular role. And then I saw that our co-boards in some, you must have read, India Hotels went off and said that we support Cyrus Mistry and so that sort of thing. And there was some discussion we had amongst ourselves, Anil and I used to involve Deepak in all of those conversations, that what do we need to do? And I said, look, this is not something we need to get into, because let them have their squabble, number 1. Number 2, our chairman, under our articles, is the power rests with our promoters, Tata Sons, to nominate. So there is no need for us to say he's better or he's not good, because we will get whoever they nominate. So why do we get into this at all? Let us instead spend our time and focus on making sure that till the long-term successor to Cyrus is selected, which now is Chandra, there's bound to be an interregnum, and there was an interregnum of about a year. We get somebody who is suitable, because it's not as if for a whole year they are not going to appoint someone. So a lot of the time was spent by me in actually talking to the people who were sort of, as it were, Ratan Tata's advisors, and who were still in a Tata Sons role, because Ratan Tata, in a formal sense, were retired. And working with them to make sure that the what I call the ninth batsman in that board was an appropriate ninth batsman, because he would have held that position for about a year, which he did. And we were successful in doing that. We also had to make sure that all of this was constantly communicated through the company. So Anil and I would discuss, the very first day we discussed, because when this suddenly came as a thunderbolt to everybody, nobody had a clue. And Anil was in Singapore. And I called him in the night because this came out in the afternoon, in the evening, and I said, I will come back at once. So he took the next morning's flight. He couldn't get the flight that was then leaving. It had already left. And when he gave him the airport, he first came and met me, and we discussed how he will communicate this to the 15,000 employees of the company as to what is the company's position, because there was obviously great morale issues, uncertainty. The person that convened an extraordinary general meeting to remove Cyrus, which I don't know why they did that. So we had to do a lot of work on all the different scenarios that may happen, because I would have chaired that meeting. So what happened if somebody came up with some Chikmagalur, the magistrates thing, saying this meeting can't be held, what should be our response? So many interesting things went on. And in the media, you have seen, coincidentally, both the sides fought their battle in the sea. On Tata, they didn't openly come out, but there were news headlines saying Cyrus Mistry took and the numbers were given of 500 to 1,000 crores kickback when the company acquired, when Tata acquired Wellspun under his chairmanship. So he took a kickback. Cyrus Mistry, obviously, not that they told me and I have any way of knowing, there were news headlines, presumably put by Cyrus Mistry, that buddies of Ratan Tata are making money in the company and siphoning it out. And then these were scenes to be investigated. So those were very interesting situations. And you had to have a very calm and dispassionate involvement in this. My own heart, to be honest, and everyone knows it, was on the Cyrus side. I think he was a great chairman. He was an extremely honest man. There was absolutely no truth in that allegation, even if there was some doubt in people's minds, and genuine doubt. I'm not blaming them. But you have to be very dispassionate and move on neither side and see what's in the interest only of the company. Consult whoever you, which was only Deepak and Anil, and behave all of us together and carry these four new directors who things they were absolutely shattered because they joined a board. And before a single meeting, there was this tremendous fight going on, and they were going to be a party to it. So you had to get them involved and keep them in the loop. So I don't know if I quite answered your question, but this is what it was a very interesting experience for the rest of my life. I won't forget it, and I wouldn't like to have missed it. It really taught me a lot of things.
This is interesting, sir, and I someday will look forward to your autobiography on how it all went through and learn lessons in conflict management. Mr. Lajmi, is it necessary for independent directors to take sides, or it's good that one behaves dispassionate, as Mr. Mirza said, and looks at objectively from a company's perspective? How does one handle this occupational hazard that comes with the independent director position?
Well, with my experience, let me share that there came a moment when I was on the board of directors as an independent director, a very sensitive moment which needed to be communicated to the chairman that, boss, we can't go ahead with this kind of way of working. So we three independent directors, we met outside, and we used to meet frequently, Anand. We used to meet very frequently outside to see how we funnel down these points and present it to the chairman, saying that if we continue, then there is a big problem, and if you don't pay heed, then we are very sorry, we will not like to ... continue. So when such a moment came, and we took guts, Nawshir sir, we took guts to communicate to the chairman that and conflict resolution. Let me tell you, our chairman was very kind to listen to us, and he took a very quick decision. He went ahead, and you know, then a new history, a chapter in our history unfolded. So we have gone through such moments, even with internal processes. There came times when budgets were being used, overused. More money was being asked by certain business heads. Less money was going to some other business heads who needed funds to revive certain activities over there. So we did meet these business heads to try and understand, you know, how we can rationalize and tell them that, you know, uh, budget utilization and budget allocation uh, is very critical, and you have to be very clear about how you utilize the budget. We can always, and in the board meetings, we had a lot of discussions on how it impacts our bottom lines. And therefore, and these questions also were being asked at the AGM कि भैया एक ही प्रोडक्ट को क्यों ज्यादा पैसा दिया जा रहा है, बाकी बिजनेसेस तो नीचे आ रहे हैं, क्यों आप सोच नहीं रहे हैं, आपका विचार क्या है, you know, these kind of, and we used to deliberate a lot. Nawshir sir, Ketan bhai and Bhavna ben, and our experience is that the board, the structure, the people on the board should be very amenable and should understand what we mean as independent directors for the good of the business. It may not, I mean, we may be satisfying a large number of shareholders because they were questioning a lot on the day of AGM. So, and they did come with a lot of study. They did a lot of study and came and asked very good questions. And we did take decisions. And yes, with a good chairman and a whole-time director and good business heads, we could find a middle path and, you know, work our way ahead. So, you know, conflict resolution in our businesses also were hard. There were pains, but we came out and the business still continues and it's contributing. So that's our experience, Anand bhai.
Sure. So, Bhavna ben, you know, these are very good examples of when independent directors have stood up to with a sense of conviction, grit, and strong personality like Mr. Mirza and Nazmi. But essentially, what we are seeing is that resignation of independent directors sometimes becomes a very easy way, especially where sometimes you lack that grit or you don't have a receptive management. As per a statistic in financial year 2020, 1,350 independent directors resigned, which is 45% more than what it was in FY19 and 80% more than what it was in FY18. So effectively, you are seeing that independent directors would, rather than standing up to a particular conflict or their viewpoint, choose to resign. And 300 out of these 1,300 candidates rose personal reasons as, you know, the reason for their resignation. So is resignation an easy way out? How does one look at this? Ma'am, you're on mute.
So first of all, Anand, I don't think the reason for resignation of independent directors is conflict at all. I think conflict, most of the independent directors handle very well, though of course one is always told that if you find that it's just not getting resolved or you just can't get along, then one should resign. But I do not believe that these resignations have come on account of conflict. Primarily, it is just the general regulatory environment which is bothering independent directors. And that's the reason why people feel that it's becoming more and more difficult to continue to serve on the boards of companies where you try to put in your best foot forward. You try to do everything that is in the interest or larger interest of the company. And yet somewhere somebody in hindsight believes that what you did was not right, and therefore action is taken. Action is taken not only, I mean, one can understand if the action is taken against somebody who's not been diligent, but it's taken even against people who are diligent, and we have examples where personal assets are attached and people have to literally wonder how they are going to pay their day-to-day expenses. So this is what is worrisome. Conflict, to my mind, by and large, everybody is able to address well, depends on the situation, but by and large, yes, all of them stand up to it and they face the challenge.
Yeah. Ketan bhai, the MCA came out with a circular sometime in July, August 2020 to say that independent directors will be responsible only if it is going through a board mechanism, and routine notices should not go to them. But that's only under the Companies Act. You can always have notices from Negotiable Instrument Act or Provident Fund Act. So this occupational hazard is the primary reason for resignation. Do you feel the same?
First of all, I would like to just make a statement that whether the independent directors resign because of conflict or the independent directors resign because of lack of comfort. So to my mind, they essentially resign because of somewhere the comfort has reduced, the level of comfort what they have on the company or the promoters or the organization has reduced, and which is beyond the threshold of the independent director, that below this it will not be for me to be within the the decision making body of the top, at the top. Coming to the question on whether the notices or the power of over regulation, so to say, and in an over regulated regime that we are living in, I believe this is a thing to stay, but the companies where the independent directors are essentially the listed entities have the mechanism to take care of them, and they don't essentially come heavily on the independent directors. The bank where I sit on the board, we have a committee on willful defaulters. So the willful defaulters committee, or there is a fraud monitoring committee, they also look at the companies which have, where the frauds have been perpetrated, and a specific question on whether the independent directors also need to be roped in as a part of the fraud or as a part of a willful defaulter. So whether their names also should be listed as a part of the willful defaulters list, which is widely publicized. And the answer is no. The only in cases where documents have proved that the independent director was more than an independent director, he was more in an executive capacity, where the documents proved that he was in an executive capacity, or where the negotiable instruments proved that he was more in an executive capacity. Only in those instances are the such, so to say, independent directors treated as a willful defaulter or as a part of the fraud. Otherwise, no. So to answer your question in brief is that the notices that comes from the different regulators or different monitoring agencies don't generally bother the independent directors, unless I would again like to qualify my statement that if the comfort level has reduced, and then what we are talking is the notices from the corners where you wouldn't like them to come from, the likes of the enforcement directorates. That's a different decision altogether, which the independent director would take. That if the comfort level has reduced, there would be, he would, in all probability, he would resign.
Sure. Mr. Mirza, since I have this esteemed technical panel over here, I am only layered to ask this last set of questions, that we anyways have a lot of regulation in terms of the governance, the board, independent directors. Is there something that you feel that still needs an improvement? Like, for example, the independent director continues to be appointed by the management. And it's an oxymoron in the sense that I get appointed by a management and I need to stand maybe against the management. So are there some tweaks required in the regulatory thing that can further ensure effectiveness from your perspective?
Anand, this is a very difficult question to answer. Actually, the independent directors are not appointed by the management. The management only recommends them at the behest of the big giant behind all of this, which is what you may call the controlling shareholder, and which in the public sector is some secretary or some minister sitting in Delhi. So the government is as guilty of abusing its role as anybody else. The fact of the matter is that we have here a situation where company law for 400 years, and company law is only about the 1850s is when most company law around the world evolved. So it's about 170 years old. But before that, we had the corporations, which were charter companies. The preeminence was always given to the provider of capital. Because of the three factors of production in the old economic sense, capital was the one scarce factor. Labor and land was available in plenty. So there was no reason for the providers of land or labor to have preeminence. The providers of capital had preeminence. And that is how the whole capitalist system evolved. And today, corporations are the creatures of the capitalist system. Now, we have a huge surge of demand in society in general, saying corporations have to now be beholden to the stakeholder, to the environment, future generations. I said the environment is nothing but a proxy for future generations. And we haven't yet developed a system which can address this particular change of displacing the preeminent one stakeholder, which is the provider of capital, with the other stakeholders, who are the providers of the other inputs. It reminds me of when I was a little boy, for the first 2 years of my life, I went to a Gujarati Pathshala in Birimora, and we saw a story, and I think that story must be there, an argument between the different organs of the body, which is the most important organ. Is it the stomach or the head or the heart? Ketan, of course, referred to the head and the heart, Bhavna's heart and our heads. But all the organs had a fight. The ultimate decision was everyone's required. You can't, human being can't exist without some part or the other. So like that, all stakeholders are required. But how do we displace this? We haven't yet evolved a mechanism. So I can't think of a way in which the provider of capital can be displaced in deciding how a company should be run. Because there are many things. It's not just the selection of the directors. It's the entire gamut of who will form the company, how will it even come into existence. Today, the provider of capital is the guy who conceives of setting up a company and makes the effort and gives birth to it and invites in the other stakeholders. And after he does that, do we say, off you go? You don't now have any more role, you are now equal with all the others on a level. So we haven't had so I can't really answer your question. I've thought many years about this, but I couldn't come with a solution. We could have constituency directors, but then it would be like our parliament. Everyone would be shouting at the tops of their voices, talking at each other, not talking to each other. We would have no movement forward.
Yeah, it would be more like a housing society in that sense. Bhavna, if there is a regulatory proposal to say that the appointment of independent directors is recommended by the promoters, but it is approved by majority of minority, just like what happens in related party transaction. Do you think that's a solution that can be applied?
Again, as Nawshir said, it's a very, very difficult question to answer as to what would really create a environment where one feels very comfortable. And as Ketan earlier said, ultimately it's when we are talking about independence and comfort of independent directors in general, we also spoke about conflict situations. So variety of things, they all have to be dealt with together. So whether the appointment is by majority of minority or by other, I mean, the entire set of people, it's a very different and difficult question to answer. What would work well?
Understood. Ketan bhai, from your perspective, any closing comments on what regulatory changes you would want to see to the current scheme of things? You are on mute, Ketan bhai.
Extremely sorry. The answer is no. I don't have any additional comments. We are already in an overly regulated regime, and I believe the regulations, more and more regulations, will only bring in more difficulties for the companies to manage way out of those regulations, rather than come out creating something better for the organization, or as Mr. Lajmi said, for the nation. So,
yeah. Mr. Lajmi, any closing comments before we take some questions from the audience?
Much has been spoken, but I wish to say one thing, that having worked as an independent director, I feel the way Ketan bhai just now spoke, that simplifying the rules and regulations will make it easy for businesses to sustain. It's very difficult in this particular situation. ये जीएसटी के regime से हम लोग निकले हैं, और बाकी सारे मामले जब नए नए regulations आते हैं, it has an impact on businesses, and it does create a lot of issues. Therefore, I think we need to be resilient, and we need to be in line with our business vision. That's all I would like to say. But simplifying the rules and regulations, for businesses not to get impacted by the stakeholders at the center and state, would make matters easy for businesses to sustain.
So I think, sir, it has been a classical exposition of wisdom on this question, at least, where the question was in terms of change in regulation, but ultimately what came out was, Anand, we need to under-regulate and not bring more regulation. So maybe that's the difference between wisdom and knowledge. And I have thoroughly enjoyed my 90 minutes with the panel. Thank you very much. Over to the student for some questions from the audiences.
Thank you, Anand. So there are lots of them. If you want, I can read them, or you can also pick it up, and we may take only whatever we want to in the interest of time. There are lots and lots of them. Yeah.
Sure. Let me maybe cover these. I think broadly what we spoke. We have the practicing CA. Yes, we shouldn't go for micromanagement. The theme that we covered. Promoters that majority shareholders would drive the agenda. A merger and acquisition happens based on informed decision. Definition of chairman and CEO and MD position. I think that's maybe one thing, Bhavna, if you would like to share your thoughts on. Is there merit in terms of separating the chairman and the CEO post, as has also been recommended by the Kotak Committee?
Correct. I see, as a chairman of the board or the chairman of the company, the function is little different from that of the CEO or an MD. A CEO and MD is, in a sense, in the day-to-day handling the business and variety of, I mean, the overall operations. Whether a chairman's role, to my mind, is more of strategic role. So gives direction and how things should be done, dealt with, handling different situations, more as a advocate for the company. So those are the areas which a chairman really handles. And also, of course, as an independent person who's chairing the board committees, to create a balance and to ensure that everybody is contributing, the direction is right, and so on and so forth. So there is definitely merit in that.
Yeah, I think the remaining questions broadly what we covered, but Ketan, I think one theme that will help a lot of participants here take home something is for aspiring independent directors, or let's say a professional who is 45, 50, been there in practice for about 20 years, how should he plan maybe getting into as a professional independent director, or what baby steps he should take? Of course, apart from giving the examination and being qualified, how does one go about being aspiring independent director?
I believe, Anand, you would be more qualified than me because you have become an independent director of several companies at a much younger age than what I am. It is how you have dealt with people during your tenure as an auditor or as a tax professional or as a chartered accountant, practicing chartered accountant, which will motivate companies or which will motivate management to look at you as an independent director, that whether you will be the right fit with all the qualities and traits that we have discussed over these last 90 minutes, and to decide to enable the management to decide that yes, this is the person who would be actually the right fit to sit in that position as an independent director or maybe chair the audit committee. So Anand, in fact, I would like to put that question to you as a last thought on this area, where budding chartered accountants or chartered accountants in their early 50s or late 40s would like to position themselves as a good independent director.
Yeah, no, I think from my perspective, Ketan bhai, what we have been or at least I have been experiencing, some of our clients, also wanting in this whole diversity thing, maybe some young blood into the board. While yes, there is a lack of gray hair, but some of these things like the digital way of doing things, or some of the business models are completely getting challenged, topsy-turvy on the digital way of doing things. Maybe some outside in fresh perspective helps. But Mr. Mirza, what is your advice as closing words for budding independent directors or aspiring? And then we can close it up with Mr.
I really find it very difficult, but I keep getting asked this question by many people in that interest. One thing they do is they inform as many people as they know who are already on company boards, letting them know that they are now in the market for such a position. I always advise them that if you have the kind of CV where a good company would want you as an independent director, send it out to the major headhunting firms like Aegon, Zender, Hunt Partners, so on. Because today, good companies do go to those firms. They don't go to that IICA list of people. I don't think, though I sit on the advisory panel of the IICA and its list of people, I've always said this is a complete waste of time. So I would rather say you go to firms like these, because these kind of firms are approached, and then they might send your name in. It depends on what kind of names they have in their portfolio compared to your name. I can't really think of any other thing to suggest. And it's a lot of good luck. How you get into these things. And like you yourself said, my first independent directorship was when the first clause 49 came in, I think 1999 or 2000. I used to be the auditor of the company. So the MD said, now we have an independent director, and the only person I could think of was you. So will you come back to this company after 10 years and become? So it was just, and from there, then things kept growing and so on and so forth. But I think if you just still get involved in your practice, don't get into this. You will find it very difficult to actually get any work.
Yeah. Mr. Lajmi, how does one get into the cozy club of independent directors, howsoever thankless it may be? If someone is interested, what's the way forward?
Of course, one thing is that you got to be a person known in your field. One, it's very important because I come from a background where I'm not a chartered accountant or a finance man, but then I had the background, and therefore my chairman and others thought it worthwhile to invite me on the board, and therefore I, along with 3 independent directors, could actually add value to the firm where I was an independent director. But I really never expected, with my background, to be on the board. Frankly speaking, I never applied. I never had the DIN or whatever. It was all post facto. Of course, it was before the appointment. But then all these things just happened in a jiffy. And I just did it because I was invited. And in future also, I would like to tell the youngsters that one thing, be an expert in your field, whatever field you are. And if you're noticed, you will be caught because there are people who are watching. And yes, good people who are at the top. And let me tell you, there was one point why there are lesser women. Let me tell you, in most of the companies where I work, there were very few ladies in senior management and top management. Nawshir sir. Now, if women don't get exposure within the organization where they work to be a part of strategy building for that business, how would they be even noticed outside, and where would they be invited as independent directors? Anand, let me tell you that more than passing exams and getting the directorship, the DIN number, I think the participation of women in strategy building, in the top management of the firms will make it easier for businesses to choose women and bring about a better gender balance on the board of directors. That one point I wanted to add when the gender balance issue had come. So all in all, I think I feel I should tell the youngsters that be domain experts, be the best in your field, and you'll be noticed. That's all, Anand. I think that is one point I wanted to add.
Yeah, Bhavna, when we started with you, and it's only apt that we end with you. Yes, youngsters should position themselves and then roll the dice. But what is your advice for aspiring independent directors?
Same as what everybody said, networking is the key, and also establishing your own credentials. Whosoever you have interacted with, they must know that you are independent, that you are expert in your field, and that you'll be able to bring in the balanced judgment when you sit on the board. So together with networking, this will help in ensuring that you get onto the board.
Wonderful. Mr. Murtuza, we are at 8:01, and I think we have thoroughly enjoyed our time. Over to you, Mr. Murtuza. Thank you.
Thank you, Anand. So, starting from whether optimistic or pessimistic, or whether right brain or left brain, I think in the last 90 minutes, what we have covered is what is the mix that we should look at. Is it like all one skill set or different type of skill sets? Representation of women, yes. And I'm sure whether we are over regulated, whether the regulation should go up or down. And I think it was very clear that like we are over regulated. And again, the last question where you even like got the information in terms of like if someone wants to become or get on a board and become an independent director, then what they should take care of. So I'm sure the last 90 minutes, there have been so much, and the variety of things that we have covered. Extremely grateful, and on behalf of WIRC, I would like to thank all of you, CA Nawshir Mirza, CA Bhavna Doshi, CA Ketan Vikamsey, Mr. Uday Lazmi, and for all your valuable inputs, and even to Anand, for Anand really well moderated, and the type of questions and the information that you got out of all of them, really grateful to you as well. And let me not even forget all the other speakers who have been there in the last 3 days. It has been really great, covering the whole range of area of what an independent director or a board member or a director would do inside and outside. So thanks to everyone. And let me also thank all the participants, 500 plus registration, and almost 150 still staying there till the end. So thanks to each and every one of you. And also let me thank CA Doshi Desai, chairperson of Committee of Members in Industry and Business, for organizing such a beautiful program. Thank you. Thank you all.
Thank you. Thank you very much. Have a nice weekend. Take care.
Thank you all.
Yeah. To all the participants, we'll also try to send this question across either to Anand or Ketan Bhai or someone and try to get the answers and even load them on the website. Yeah, thank you.
Thank you, Murtuza.
Thank you, Anand. Yes.